Now we are coming to part 3 of this video class. Here we are going to see how accounting equation of asset equals capital plus liabilities is maintained throughout the accounting process. So for this we will be using a set of transactions and we will consider them one by one, and you will notice some interesting features regarding this relationship between assets, liabilities and capital. I just give a simple example. If your assets are 10 and liabilities are 3, you know the capital will be 7. Asset minus liability equals capital. That means asset equals liabilities plus capital. Now you have to use notebook and pen. You have to copy these questions, and then we will go to Excel sheet where we will consider these transactions one by one and see how the accounting equation is maintained with each of these 7 transactions. Okay, we'll go to the Excel sheet first, and I made it a bit colorful and all that so that you will get, I'll write the names of assets one as they come into the business here. Say for example, you get cash, you get furniture, you get buildings, all these things will come here one by one, and then on the other side you will see how the liabilities are coming or how the capital is coming into the business. This video is very interesting and you will understand some very important concept, basic structure of accounting process. And here you can see you will see the totals, and just making a double check. Okay, so you don't have to do it in the notebook. You will need only this part, this highlighted part, and of course these are for the 7 transactions. I put this to save time. Okay, so now you just watch the video, and after finishing this video you must go back to the transactions and try to do accounting equation yourselves. Right, okay, now we will go to the first transaction. Started business with cash. So in each of these 7 transactions you will find one asset coming in or going out. For example, when this man started business with cash, you know cash has come into the business, right? So we will say first asset, I'll just put the total here, first item here, cash. Cash 10,000 has come into the business, right? Now from where this money, now assume this is a balance sheet. Okay, so you have cash 10,000 against which, whose money is that? It should either belong to the owner or to an outsider. In this case obviously this money belongs to the owner. Now if you make a balance sheet, on the asset side you will write cash in hand 10,000, liabilities nothing, and capital 10,000, balance sheet tallied. Okay, now this is for making a cross checking, double checking. These two numbers should be equal all the time. In other words, if you increase or decrease any of these assets, I just made provision for 1, 2, 3, 4, 5 assets. So if you have more assets you can have more columns here. So just I will just make, okay. So anytime you increase an asset here, you must counterbalance it by either decreasing an asset or by putting anything on the other side, liability or capital. Then these two numbers will be equal. These two are the total of this side. You can see total of assets here, total of this comes here, and total of this comes here. When you do it in the notebook you don't have to do this part, only you need this highlighted area, only this much. It is up to here. That is enough for you, and this is only for second check. Alright, okay. Now, asset has increased by 10,000 and capital also has increased by 10,000. That is the first transaction. I will just do some cosmetic work. Right, okay, now we go to the second transaction. After 2 or 3 transactions, you will understand how these things are connected. Now, furniture. Purchased furniture for 1,500. Now, notice there is a second asset coming in. Remember, when you have furniture, this is a second transaction, and notice the numbers also here. There are 7 transactions. Now we are on the second transaction. Furniture of 1,500 has come in. Now, how to balance? Each of these lines should individually balance so that you will have the same total here. Now you can see now it is out of balance. Now furniture 1,500 has come. If that furniture is given by an outsider, we would write it here. If it is given by the owner, we would write it here. It looks like owner has given the furniture. No. In this case, it is not additional furniture brought in by the owner. Instead, owner takes out cash. So the transaction balance is here by removing cash. Minus 1,500. Now you see, this has balanced. So every time you increase an asset, you must see to it that in the same line, you should either increase and decrease an asset, as in this case. Here you can see, increase of one asset balanced by decrease of another asset. Or increase of an asset should be counterbalanced by increase of either liability or capital. I am repeating these things because this is the first time you are coming across these things, and it is very important that you understand these connections. Increase of asset counterbalanced by increase of capital. Increase of asset counterbalanced by decrease of asset. Either way it is okay. Now we go to the, you can see the total again remains the same. You can see a balance sheet developing here. In your first balance sheet, you had cash 10,000 and capital 10,000. Now there is a second balance sheet here. You have furniture 1,500, cash 8,500, and other side capital 10,000. Now you are going to get a third balance sheet. Purchased material for sale. Purchased material for sale 5,000. This is the third transaction. Now material for sale, we say stock of, I write stock, or you can say merchandise inventory. So easier word I think is stock. Purchased material for sale. That means you paid cash and material came in. One asset out and one asset in. One asset out and one asset in. Okay, it is same. Okay, look at this once again. Purchased material for sale. So don't assume that the capital has increased or decreased. Nothing will happen to the capital. You are simply shifting asset from one box to the next. Earlier you had cash of 10,000. Took that cash and converted that into furniture. Okay, I'm using the word converted. Your cash has become furniture. Now you have cash 8,000 was left, so you converted that into stock of material. Right, now we go to the fourth transaction. Borrowed from a friend 6,000. Now notice very carefully. You went to a friend, borrowed money. You got money, cash 6,000. Did any of the assets went down to counterbalance it? Did any of them reduce or decrease to counterbalance this increase. Now, you don't have any asset going down, instead you have your first liability coming in. So this increase in asset is counterbalanced by an increase in liability. This liability is called loan. This is capital. I write it once again to make it symmetric. Capital. So this is a loan from your friend. You can see this here. Asset has increased by 6,000. No asset decreased. Okay. Now you have a liability gone down. Sorry, a liability increased by 6,000. Now you can see the balance sheet again. Asset 16,000. Cash in hand 9,500. Furniture 1,500. Stock 5,000. This is the total of balance sheet is 16,000 on the asset side. On the liabilities side, you have loan of 6,000 and capital of 10,000. So the liabilities side total 16,000. So that is your balance sheet. This is your fourth balance sheet. Okay, you don't have to prepare balance sheets after each transaction, but you have to make sure that these things always balance. That's why we call it accounting equation. Assets equals what? Liabilities plus capital. Okay, come to the fifth transaction. Borrowed, okay, purchased more materials for 3,000. Purchased more materials for 3,000. You know which all are the assets affected here. Your cash will go down, minus from your cash and plus to your stock. Once again, decrease in cash 3,000, you are paying money. Okay, and increase in stock plus 3,000. Okay, minus 3 here, plus 3 here, plus 3 in stock, minus 3 in cash. Balance sheet now looks, the total is the same. Your asset has increased, cash has your stock has increased and cash has decreased. So that's what happened here. So that is your fifth balance sheet. And now sold half the materials for 6,000. This is the most tricky transaction. We call it tricky transaction because now you're going to have a little bit of confusion here. Half of the materials were sold for 6,000. Half of the materials. Now, can you tell me how much is the total material in your store? How much? 8,000, right? Half of the materials out. Half of 8,000 is out. Okay, fine. When an asset goes down, you have to counterbalance it by another asset going up, or there should be an increase in an asset or decrease in a liability. Okay, now minus 4,000 here, that means there should be a plus 4,000 somewhere here, or a minus 4,000 somewhere here. You got it? So anything you do here, you must do on the other side also. Means the result will be equal. Now 4,000 minus. See the transaction once again. Sold half the materials for how much? 6,000. So 4,000 minus, okay, plus how much in the cash box? This is called trouble. Your cash increased by 6,000, stock decreased by 4,000. In other words, You took the stock of 4,000 and sold it for 6,000. This is a normal thing that happens in a business, right? You're not going to sell your stock of 4,000 for 4,000 rupees. You made a profit. Your asset side has increased. Notice the total here. Asset side has increased by 2,000. Can you see this? Asset of 4,000, stock of 4,000 was sold for 6,000. That means you got an extra 2,000 on the left hand side. Now how will you adjust this? Whose money is it anyway? Who is the owner of that 2,000? You don't have a liability. That money goes to your capital. Notice this transaction very carefully. This is very important. Closely watch it. Asset of, if you make a profit or if you make a loss, that has to go into the capital account. That is the simple meaning of all these things. Asset of 4,000 was sold for 6,000, and in the process you made a profit of 2,000 here. That profit is added to capital. So the owner has become richer by 2,000. Before he had only 10,000, now he has 12,000. So one transaction. Minus 4. If it was a plus 4, then the matter would have finished there. But this minus 4 has resulted in a plus 6. So there is an increase of 2,000 on the left hand side of your equation. Now you need to have an increase of 2,000 on the right hand side as well to make it balance, right? Now we go to the seventh transaction. Paid half of the loan, 3,000. Okay, so far we haven't touched expenses or incomes as such. We will see it later. Now half of the loan. Paid half of the loan, 3,000. Anyway, it is a simple thing. You know that loan is 6,000. Half of the loan is 3,000. That amount is paid. So from your cash, you paid 3,000. That means your liability, okay, you can see it here, the total has become 15,000 on this side. Your cash has gone out. So anytime your cash goes out, you must have something coming in or something going from the liability side. You can see this once again here. Just before I go further on this seventh transaction, come back here to the second transaction. Your cash of 1,500 went out, but it brought furniture. Now here your cash of 5,000 went out and it brought stock of 5,000. Your cash of 3,000 here in the fifth transaction out, and you got stock of 3. Now here your cash of 3 went out. It's not bringing in any new asset, instead it is finishing off a liability. Half of your liability gone. Now your loan is only 3,000. Now you can prepare a balance sheet from this. Okay, if you are doing a balance sheet, preparing a balance sheet, you'll have to show stock here. I think I'll write it here. Just do, okay. I will just show you the balance sheet also. Just a quick balance sheet, okay? So I just try to save time, avoid typing. Cash, furniture, then what else? You have stock. That's all, I think. 3 assets. And cash is how much? Cash is 9. You can type 9,500, but I just want to do it. Furniture is how much? 5,500. And you have stock of 4,000. So the total of your asset is 15,000. Okay, this is the total assets. You have to write assets. Now you write capital. Liabilities. Liabilities, first one is loan. There is only one liability. Loan, loan, and then leaving a line, you write capital. Right, loan is how much? It is 3,000. You can directly type 3,000. And your capital is 12,000, and you get the total. Once again, you get the total of 15,000. Right, now this is what we call a balance sheet. Right, okay, this is your balance sheet. We'll just put some boxes around so that it will look like a balance sheet. Right, now you have for this, and right, good. And now you make it look a little bigger here. Balance sheet. Okay, good enough. Quick balance sheet. So if you look at this balance sheet, you have seen there is cash 9,500, furniture 1,500, stock 4,000, giving you a total of 15,000. On the liability side, you have a loan of 3,000, capital of 12,000, giving you a total of 15,000. That's all now. See you in the next video. Thanks for watching.